Welcome back to JPX Energy Market Weekly Updates. Oil futures finished higher on Friday. Middle East benchmark Dubai crude registered gains nearly 5% on the week, largely reversing losses from the previous week as sentiment again shifted back to a positive mode on growing optimism of China, as well as reports that Russia could voluntarily slash production, which was enough to outweigh concerns over growing oil inventories in Europe and the United States. Inter-month spread of oil benchmarks edged higher, indicating a more tightened market. On the demand side, global air traffic in 2022 reached 68.5% of its pre-pandemic level, according to the International Air Transport Association. This momentum is expected to continue in 2023, as data from Radarbox showed that the number of international flights to and from China is steadily recovering. OPEC expects oil demand to exceed pre-pandemic levels in 2023, reaching almost 102 million barrels per day, and demand is projected to further rise to 110 million barrels per day in the next 2 years. On the supply side, Russian Deputy Prime Minister Alexander Novak said Russia will voluntarily reduce oil production by 500,000 barrels per day in March. Previous survey by Plus shows that Russian production remained relatively resilient to the impact of sanctions. Crude production volume fell just 10,000 barrels per day in January to average 9.85 million barrels per day, as the market found ways to sustain flows of Russian crude so far. Besides Russian raised refinery throughputs, and appear to have stored significant volumes to keep the taps open. Analysis that forecast that Russian crude oil production would eventually fall between 1 to 1.5 million barrels per day in 2023, as refineries are forced to cut runs and storage facilities reach capacity. So it's expected that Russian production cut will tighten market balances in 2023, but any immediate further price gain spurred by the news is unlikely, as it is more or less within market expectations. Prior to comments from Novak, softer sentiment was largely triggered by the temporary well-supplied product market on both sides of the Atlantic Basin. Latest EIA stats revealing inventory builds for distillate, which is mainly diesel, for a third week in a row. EU middle distillate stocks have also increased as company bolstered supplies ahead of EU sanctions on Russian products. European refiners' crude intake in January was up 6.3% from a year earlier at 9.75 million barrels per day. Diesel flows into Europe also remain high, as around 4.77 million tons loaded before February 5th is scheduled to arrive in Europe this month. So looking ahead, while Russia cut product supply, refinery runs in other parts of the world will increase to fill the gap as global refining margins for middle distillate remain relatively high. Higher refinery runs will lead to more tightened crude oil market, but a more well-supplied product market. Demand and crack spread for jet fuel, kerosene, and diesel lies in the core of oil market fundamentals for the rest of the year and should be followed closely because it's directly linked to refinery margins and their willingness to increase runs. Okay, that's all we have for this week. Welcome back next week.